Hello and welcome. Today, we're going to dive into the world of conforming loans. As an aspiring real estate professional, understanding conforming loans is crucial because they are one of the most common types of home loans you encounter in the industry. What are conforming loans? Conforming loans are mortgages that meet the standards set by two government-sponsored enterprises, Fannie Mae and Freddie Mac. These organizations buy mortgages from lenders, allowing lenders to free up capital and issue more loans to homebuyers. For a loan to be considered conforming, it must meet certain criteria regarding loan size, borrower qualifications, and documentation standards. These guidelines are established by the Federal Housing Finance Agency, FHFA. Loan limits. One of the defining characteristics of a conforming loan is its size. The FHFA sets annual loan limits, which can vary by region. As of now, the baseline loan limit for a single-family home is $726,200 in most parts of the United States, but it can be higher in high-cost areas. It's essential to check the current year's limits because they are adjusted annually based on home price trends. Loans that exceed these limits are considered jumbo loans and typically have stricter underwriting standards. Conforming loans offer several advantages. Lower interest rates. Because conforming loans are considered less risky to lenders, they often come with lower interest rates compared to non-conforming loans. Easier qualification. The guidelines for conforming loans are well defined and generally easier for borrowers to meet compared to the more complex requirements of non-conforming loans. Predictable terms. Most conforming loans are available as fixed-rate mortgages, providing predictable monthly payments, which can make budgeting easier for homebuyers. To qualify for a conforming loan, borrowers typically need good credit score. A minimum credit score of around 620, though higher scores may secure better interest rates. Stable income. Documented proof of steady income to demonstrate the ability to repay the loan. Debt-to-income ratio. A debt-to-income (DTI) ratio generally not exceeding 45%, although this can vary slightly depending on other factors. Down payment. A down payment of at least 3% for some programs, though 20% is ideal to avoid private mortgage insurance, PMI. Conforming loans are a cornerstone of the mortgage industry, offering accessible financing options for a wide range of homebuyers. As a real estate broker apprentice, understanding these loans and their benefits can help you guide clients through the home buying process and recommend suitable financing options. Thanks for tuning in. If you have any questions or need further clarification on conforming loans, don't hesitate to reach out. I'm here to support you as you grow in your real estate career. Good luck, and I look forward to seeing your success in the industry.